People around the world are experiencing first-hand inflation taking off in all sectors of business. And not just that, even the big leagues and super successful investors have taken notice. Business people like Warren Buffett, Ray Dalio, and more even believe that inflation will rise exponentially further in the near future. Sitting in the back row and watching everything is another entrepreneur or investor believing quite the contrary. Cathie Wood believes that the opposite will take place. In fact, she thinks it'll be deflation. Our video today, we will dive deep into why this is the way Cathie thinks and how data backs it up. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. Wood began her career as an economist with decades of experience, so it's vital that we see what Cathie has to say, regardless of any prejudged notions. In the early 1980s, Henry Kostman and Friedman, two very famous economists, claimed that inflation will continue forever. Meanwhile, Cathie, a relatively new economist at the time, thought that inflation was gonna eventually cool off. Not surprisingly, Cathie Wood is making her bold prediction against the grain. The first signal pointing towards increasing inflation is the money supply. The supply of empty money has increased significantly ever since the pandemic started, and money is a measure of the US money supply. That includes savings, deposits, checks, cash, checkable deposits, etc. And with the rise of stimulus checks, it's not really a surprise that empty money has increased dramatically. But Cathie Wood saw the trend, which is the trend that empty money growth has slowed down rapidly, and money growth has slowed down from 27% in April this year to just 17% in May. This slowdown is most likely why the bond market has been rallying over the past few years. 10-year Treasury bond yields have been suppressed through roughly 1.5% after peaking at 1.7% in March, because bond yields and bond prices are inversely correlated, meaning the bond market has been rallying as yields are going down. When this happens, we are aware that the bond market is predicting deflation than the opposite. Not many economists have observed recently. The money growth rate has been cut in half from 27 to 13.8%. Maybe the bond market is too focused on that. It seems that the bond market is rallying because of the artificial buying power of the Federal Reserve, but actually, the Fed has been purchasing bonds for some time now, like months. And this isn't a new factor in the bond market. The buying power from the Fed has not really changed this whole time, as even when the bond yield spiked during March, the Fed's buying power remained. Actually, the Fed plans to sell some corporate bonds and corporate bond ETF that it bought during the pandemic. Preceding the high inflation reports, Cathie Wood, like every economist, actually expected the bond market to sell off. But bonds instead continued to rally. The CPI reports that they have gotten, and PPI as well, are much higher than expected. She expected the bond market to continue to sell off and interest rates to rise. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43. No matter how strong the economic data has been or how high the inflation numbers have been, meaning the bond market is sniffing something out. But quantitative easing was true at the beginning of this year, and through March when it went from 0.9 to 1.74. So nothing's really changed on that score. But the bond market is sniffing something out. Cathie may sound crazy, but she does actually expect inflation to stay for the next couple of months. Personal consumption expenditures price index indicates that prices have increased 1.6% year over year in February to 3.9% in May. But Cathie thinks that this inflation rate will increase all the way to 500, as inflation could heat up for the next couple months. Down the road, Cathie states prices will be going down. Increasing prices of oil ironically sets the stage for deflation. The OPEC, which is a group of many countries that control the supply of oil, is determined to make back some profits by keeping the oil supply low, which may be counterproductive, because with the rise of oil prices, more people resort to electric vehicles. In the pandemic, EV sales have increased disproportionately to fossil fuel vehicles, This is partly influenced by increasing gas prices, and also the idea that EVs are more superior to gas power. Once oil prices continue to increase, it will incentivize more and more people to purchase EVs, which lowers the long-term demand for oil. Crude oil is currently sitting at around $75 per barrel, which is approaching the previous high of $77. Cathie believes that oil will go down to about $3 to $12 per barrel. That would be an immediate 84% decline from the current price. If these prices become reality, substantial deflation occurs. With one of the reasons is OPEC, and they have about 5 million barrels. If they have that, they can produce daily. They want to maintain the oil price as high enough so they can fund their budgets. At some point though, they may kill demand when they see demand reduction because of the high pricing. They'll most likely begin production again and the prices will go lower. In longer term, the combination of electric and autonomous electric vehicles might drive oil prices down. In Cathie's point of view, they haven't done the research to get them here yet. She thinks it could go down back to where oil prices landed right after the cartel took over in the early 70s. We wouldn't be surprised to see the economy back there, especially as EVs continue to take off, and they are evidently starting to take off significantly. A different piece of data that points towards deflation is the purchasing power of the US dollar. In the past month, the dollar index has significantly spiked up. It directly contrasts with fears of inflation in the dollar, as the dollar is actually gaining its purchasing power in comparison to other currencies. It may be due to Biden's corporate and capital gains tax arriving lower than expected. Also, commodities have been crashing lately. Lumber prices in particular have taken a sudden turn downwards toll, to which Cathie actually predicted before the crash happened. There are also a couple of other signals, including China's pork prices, copper prices, to which Cathie mentioned by saying that against the consensus expectation, in terms of currencies, the dollar beginning this year versus end of this year is not going down. That's also consistent with the bond yields coming down. Actually, the last factor is consumer demand. As consumption drops 0.4% monthly, durable goods consumption in particular is down 4.3%. And in non-durable goods consumption down 0.5% monthly. At the same time, services consumption is only up 0.4% month over month, which is not as high as the declining goods consumption overall, as demonstrated by the crash commodity prices. Goods consumption and the showing of growth in the money supply inflation might not really be a bad situation. Contrary to this, as you look on the other side of the spectrum, countless counter-arguments from successful investors and business people like Ray Dalio calls out the bond bubble, claiming that the hyperinflation is coming to a peaceful calm. We believe that eventually in long term, inflation wouldn't be a big bad issue. For now though, yes, it is in fact higher than expected due to increase in consumption. Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video!